I want to introduce Dr. Kelly Lange. She's an assistant professor and director of the Farm Op with our Department of Ag and Applied Economics, and we're going to talk about planting the seeds for our financial future. So take it away, Kelly.
All right, well, thank you for the introduction. I'm glad everybody can join us today. So just a little bit of background quickly on how I got to be involved in some of the personal finance stuff. So even though, yes, I'm in the Department of Ag and Applied Economics, when I did my Ph.D., I had an option to do a minor in personal financial planning. So I did that as well. So I work in the areas of farm management, but I have actually been able to tie in a lot of personal finance because many farmers and farm families manage their businesses and their personal finances kind of together. So I actually get to blend these two topics a lot. So I get really passionate about talking about financial planning. I think it's something that everybody needs to have an awareness of, needs to be familiar with, because ultimately it can save you a lot of money over time if you are aware of your personal finances and know how to manage that stuff. So with that, I'm going to go ahead and get going. So just kind of an introduction of what is personal finance. It actually encompasses a lot of different areas, and it's the activities that include management of keeping track of your cash flows. So all that's going to be all the cash that's coming in and all the cash that's going out of your personal checking account or bank account, whatever that would be. It also involves tax management. Tax management can get really involved. Taxes obviously are complicated in a lot of cases. So tax management is going to be a big issue, especially for people as they age and they tend to kind of advance through their careers. As your income levels go up, your taxes are going to go up. And so there are some good strategies for managing taxes as well. Debt management is a huge part of personal financial management, and it's one of the areas that a lot of times people can find themselves into some debt trouble when they don't really intend to be. It's pretty easy to get into some issues with debt. So management of debt is very important. Insurance is another big area for personal financial management. So making sure you have got adequate insurance coverage for things like life insurance, health insurance, auto insurance, homeowners insurance, things like that. So I'm going to touch on just a little bit of some basics of insurance today. Also, investment planning is another huge realm of personal finance that you could spend a lot of time on that topic just by itself, but it's basically involves how do you manage different types of investments. That can be anything from financial investments such as stocks and bonds and mutual funds, things like that, or even investments like in real estate and things like that. Retirement planning is a part of personal financial management, and everybody kind of talks about the importance of retirement planning and the importance of planning early, but sometimes that's easier said than done to try to implement it. But if you understand the basics of retirement planning, it actually can be pretty simple. I've got an example later on in the presentation that shows how kind of pain-free sometimes retirement planning can be. And then finally, estate planning is also a large part of personal financial management. That is a topic that people tend not to think about until they get a little bit older, until they have accumulated enough assets and enough wealth in their estate that they want to start deciding what do they want to do with that estate once they've passed on. So would they want to, bequeath their assets to children or their family members, things like that. So estate planning tends to be one of those personal finance topics that people think about a little further down the road once they're a little bit older. But all of these activities make up personal financial management, and the idea, the overarching goal behind financial management is that you've got some sort of financial goals in mind, things that you want to achieve with your money, and you need to manage all of these activities in order to achieve those financial goals. And always remember, at the end of the day, ultimately the management of your money is your responsibility. Very few instances where somebody's going to be able to make those decisions for you. When it comes down to making those hard financial decisions, it is your responsibility and nobody else's. And so as part of that is your responsibility to be as knowledgeable about these topics as you can, because if you're more knowledgeable about some of these issues, you can ultimately save yourself a lot of money and make some good financial decisions over time. So This is kind of an overview of the main points of the presentation I put together today. So we're going to talk about some basics, which start with developing a budget and learning to track your expenses. How do you build up a savings account? How do you use credit and credit cards wisely? Those can be useful tools if you use them well. How do we make sure that we have proper insurance coverage? I'm going to talk a little bit about the basics of home and vehicle purchases. Those tend to be two of the largest purchases that people make in their lifetimes. I'm going to touch just a little bit on the importance of planning for retirement early, and then always keep in the back of your mind kind of the overarching goal of this presentation is to help you learn to think before you use your money. Sometimes it's easier said than done, is to just stop and kind of ask yourself, do I really need to do this, or would I be better off doing something else? So to start with, what a lot of people have trouble with is when they have excess income, they don't know what to do with it. So one of the very first steps in trying to manage your personal finances is to develop a plan for your excess income. So if you end up with a little bit of extra money that you weren't expecting, or if you get a raise at your job or something like that, what do you do with it? So the steps to developing that plan, the first thing is make a budget. So you need to have a budget. You need to have an idea of what your typical income and expenses are and what you can do to try and manage that a little bit better. And so developing a budget is the best way to do it. And then the development of the budget tends to be relatively easy. It's sticking to it that can be a little bit more difficult. And then the next step is when you do have excess income, one of the very first things to do is make sure you do have proper insurance coverage. A lack of sufficient insurance coverage, if you were to have a case of, an auto accident, or if you got sick and you didn't have medical insurance, you can run up some tremendous debts. And so getting proper insurance coverage is one of the very first things that you should look at doing when you've got some excess income. Then, if you've got some additional income that you would like to allocate somewhere, consider paying off debt that you may have. And there are several different kind of philosophies of how you should pay off your debt and how you should manage it. One step that a lot of people tend to gravitate to is to pay off their high interest debt first. So credit cards tend to be one of the things that carry the highest amount of interest associated with them. So if you've got an opportunity to pay off that credit card debt, take it, because you can save yourself a tremendous amount of money over time. I've got an example of that a little later in the presentation to kind of show you how that can help. Another strategy that some people implement for managing debt is if you perhaps can't pay off your highest interest rate debt in full, then consider paying off interest that might have a lower rate associated with it. But if you could pay it off in its entirety, then that is that much money you're saving by not paying in that interest. Once you've gotten insurance coverage and you've been able to kind of get your debt under control, then start looking at building up your savings. And I'm going to talk about the importance of having kind of a contingency plan for your savings here in a minute. But then kind of your overarching plan for this needs to be develop your goals. So think about how you want to use your money. What do you want to be able to do with that money? Not just in the near term, in the next month, in the next 6 months, in the next year, but be thinking about what do you want to do with that money as you get years down the road, particularly whenever you're headed toward retirement. So make a to-do list. It's just like you would do for anything else that you needed to manage. Sit down and make yourself a to-do list. What do you want your money to do for you? And then start thinking about investing for your future goals, and retirement is going to be one of the big ones on that. So on developing a budget, this is a place that is kind of your jumping off point whenever you start getting ready to manage your finances. And it's a scary step for a lot of people. And this is why a lot of folks don't get past this point, is because it can be really scary to sit down and take a good, long, hard look at what you are actually spending your money on. So when you develop a budget, you want to make a game plan for your money. You need to figure out how do you want to spend your money and what are your biggest priorities. Are your priorities going to be saving up to buy a house, to save up to buy a car, to save up to fund your children's education, to save up for retirement, or all of the above? You have to figure out what your financial priorities are. Then this is the part that gets kind of scary sometimes, is look at your typical income and expenses. And the way you do this is you need to go back, go through your bank records and look at what your past spending has been. And this is where you need to look at what are the typical expenses that you have. So what is your typical income you have coming in? What are your typical expenses? And we all have things that come up unexpectedly. You know, you have emergencies that come up, the car needs repairs or something like that. Those are things that you need to plan for, but those are not going to fall into your typical income and expenses. So you need to look at what is the normal stuff. That is where you start on your budget, to have an idea of then how much could I be looking at saving out of my leftovers once I've paid all of my typical expenses. So the way that you can then kind of begin putting your budget together, it's a process that's going to take a little bit of time, but once you've looked at your past spending habits, start tracking your income and expenses. So keep track of what is coming in and what is going out, either on a weekly basis, on a couple of weeks basis. Some people like to do it on a monthly basis. It's you kind of have to experiment with it and find the process that works the best for you. Some people like to use budgeting software. There's a lot of really, really great softwares out there you can get, but you don't have to do anything really all that fancy. You could just sit down and get yourself a notebook, or if you want to make an Excel spreadsheet to track your income and expenses. Personally, I actually built myself an Excel spreadsheet that I've got my monthly budget, and I keep track of everything that comes in and everything that goes out in that. And I just update it. I go and update it a couple of times a week or a couple of times during a couple of week period, and just it helps you to kind of stay on track when you're managing that stuff if you're looking at it frequently. So that is one of the biggest reasons why it's helpful to have a budget that you can look at consistently. So once you get your budget kind of set in a format that you like, compare your actual expenses to what your budgeted amounts are. And you may need to adjust, and you probably will have to adjust some of those budgeted amounts. We all have this kind of idealistic idea in our mind of what we would like to be spending as opposed to what we're making, but the reality is that sometimes we don't put that budget together quite as realistically as we should. Make your budget realistic. You need to make sure that if you need to allocate an extra couple $100s a month toward your expenses, go ahead and do it. It will be much easier to stick to a budget if you have a realistic budget. So if you know that you typically spend $1,000 a month on various expenses, but you only budget $500, you're going to find it really hard to try to stick to that budget. So make it realistic with what your actual income and expenses are, and then revise it periodically as needed. So if you change jobs, or if you get a raise or something like that, and your income level should go up, then you might be able to realistically increase your expense level, or you might want to change your budget to where you're allocating more of that money to savings or something like that. So you're going to periodically revise your budget as you need to. But that's, again, why it's important to take a look at that budget on a regular basis. The more you look at it, the more it's going to keep you aware of what your spending habits are. So this is just a little basic, simple daily expense tracker that I had put together. Like I said, you don't have to have anything fancy for your budget. You can make it as fancy or as simple as you want to. But what you do is just for each day of the week, record everything you spend for that day of the week. And when I say everything, I mean everything. If you run by Sonic and get a drink and you spend $1.31 on your drink, even if you pay cash for it, record it, because those are little expenses that can add up quickly. If you go out to lunch most days of the week, it's really easy to go out and not really pay attention to what you're spending on lunch. It can be eye-opening to sit down and track your lunch expenses for a couple of weeks, and you realize, wow, that was $50 that week that I could have saved a lot of if I had brought my lunch with me to work or something like that. So record everything you spend. It can be very interesting and very eye-opening to see what you do actually spend your money on. And then also include if you've got any kind of special expenses. So if you had something come up unexpectedly, you know, somebody's birthday that you forgot about, you needed to get a gift, record that as a special expense. That wouldn't be something that you would typically be spending every week, but it is an expense that you would need to record. Or if you have something like an emergency, you know, your car breaks down and needs a repair or something like that, those would fall under special expenses. So like I said, you don't have to make anything fancy. Just something, and you can modify your system to something that works for you, but the main thing is to just keep track of what you're spending. It is very, very interesting whenever you stop and take a hard look at what you're spending. You start finding places that you could actually end up probably saving quite a bit of money. So cash and credit management, this kind of goes along with your budget. So once you've got a good budget in place, you need to figure out, okay, how do I want to manage my cash and how can I manage credit that I may have? So the problem we all have is cash tends to burn a hole in our pocket, and it can be really hard to exercise self-control when we're managing our cash. If you've got, cash on hand, like I said, it's really easy to go out to lunch, and next thing you know, you've spent $10 or $15 on lunch, and that's $10 or $15 in cash that's gone. So sometimes what people like to do is look more toward like debit card checks. We don't tend to write as many checks as we used to. A lot of people operate on debit cards now, but debit cards can be helpful in that they are tied directly to your checking account, not a credit card. So it can keep you from spending money that you don't have in that account. The problem with credit cards are great. Credit cards can be very useful tools, but sometimes it's way too easy to go put things on a credit card. You have to develop some self-control and learn to use discretion to keep your credit card usage in check. Building up savings. So one of the things to know about savings is that a lot of times people tend to think of savings as, I'll put whatever's left over at the end of the month in savings. Well, inevitably, you don't end up with much savings because you've already spent everything else you had on various expenses, whether they were necessary expenses or if they were entertainment-related expenses, something like that. So the thing to know when you're trying to build up savings is pay yourself first. So get an idea in your mind, and this is where you'll go back to your budget and determine how much can you realistically allocate towards savings. But pick you an amount like $100 a month or $200 a month, something like that, and allocate that towards savings first before you start paying other bills. That will make sure that you don't run out. And when people try to say, oh, I'll just put whatever's left over at the end of the month in savings, inevitably there is nothing left at the end of the month. So put that into savings first, then start working on your other expenses. Now, savings are really important, and this is why a lot of people run into problems when they do not have adequate savings. Savings is an emergency fund. It provides a financial safety net that gives you the ability to meet unexpected bills if something unexpected should come along. This situation we're in right now with COVID-19 is a perfect example. Nobody really saw this coming. A lot of people have had to tremendously change the way they're living. Expenses have changed. In some cases, people's incomes have changed. Some people may find themselves in a situation where they're now unemployed and they weren't expecting it. That's where having savings helps in a situation like this. You need to try to have adequate savings to cover, kind of bridge a gap in there if it ever came to that situation. Adequate savings is also going to reduce your reliance on credit cards, because what happens in a lot of cases, if somebody has an emergency come up, they don't have savings, so they go and they put it on a credit card, or they have to take out a loan to cover whatever that emergency expense is. That just means you're going to have to pay that much more in interest then whenever you try to pay that off. So a goal that you should aim for is to try to have 2 to 6 months worth of savings that would cover your typical expenses. So that's those typical expenses that you were tracking with your expense tracker. You'll have an idea of what you need to be putting away for savings each month. And people say 2 to 6 months. Well, that's a lot. But again, look at the situation we're in currently. We're now, almost 3 months into this COVID-19 situation. So if you had a 6-month buffer of savings, obviously you're going to have to be, watching your expenses and things like that, but you would be okay in most cases if you've got that adequate level of savings. So it takes a while to get to that point where you have 2 to 6 months of savings. It is not easy to get there, but that's why it's important to try to set those savings aside before you pay any other expenses, and it will build up quicker than you might realize. So that the importance of having several months of savings to cover your typical expenses, it cannot be, it's hard to overestimate the importance of that. So that is one of your first goals, is to try to make sure you've got an adequate emergency fund. So on credit cards are interesting. Everyone should probably try to have one credit card. If nothing else, you've got it there for an emergency situation, but you have to be really careful. You don't need to get too many. And credit card companies are really good at trying to entice you into taking out credit cards. We all get these credit card offers that come in the mail constantly, constantly bombarded with them. They offer these introductory rates that sound so great. Well, if you read the fine print, a lot of times those introductory rates can then turn into some tremendously high interest rates. So you should probably try to have one credit card, shop around and make sure you find one that fits your needs, but try not to have more than 3. There's some scary statistics out there. The average consumer in the US actually has about 4 credit cards on average, and they carry a balance on all of them. That is a tremendous amount of money that is being paid and essentially lost each month then in interest payments. So be very careful on your credit cards. In general, you should try to average no more than 20 to 30% of your credit card limit that you use. So if you've got a credit card, for example, that has a $10,000 balance on it, or not balance, I'm sorry, $10,000 limit, that does not mean you should go out and put $10,000 worth of stuff on that credit card. You're going to have interest accumulating on whatever that balance is. Try to hold your usage of that credit card to about 20 to 30% of your limit. Obviously, you have that credit card there. If you had an emergency and you needed to use that, you could, but you want to try to avoid that if possible. And then pay off as much as possible each month. So in a perfect world, ideally, you would want to try to pay off the full balance of that card each month. That would then reduce, or in the case of paying your balance off every month, that would eliminate your interest charges that you have every single month. So essentially, you get to pay for things on a cash basis over time. That is a really good strategy for using your credit cards and using them wisely, is if you can pay off as much, or if not possible, try to pay off all of your balance each month, you will never have to pay interest charges on a credit card. So credit cards can be a really good tool if you use them wisely, but they are a tremendous, terrible, horrible curse if you do not use them very well. And misuse of debt and credit cards is the #1 reason for bankruptcy in the US. So some of the do's and don'ts of using your credit cards. So only use your credit card. This is easier said than done. Only use it when you have the money in checking to pay that credit card off. A lot of us don't adhere to that because the temptation can be too strong sometimes to go spend that money. Say, well, I'll just put it on my credit card. Well, just know you're going to end up paying more than you would have for whatever that item was if you have to pay interest charges on that credit card. Do try to make more than the minimum monthly payment. So if you pay off more than your minimum payment, or ideally if you pay off your full balance on your credit card each month, you're not going to have to pay a whole lot in interest charges. You can save yourself so much money if you do not pay credit card interest. Check your credit card statement often. This is it's a strategy to try to avoid identity theft. You need to make sure that the charges on that card listed are yours. Nowadays, that's really easy because we can all hop online and go check our credit card every couple of days. That's what I recommend is a couple of times a week. Get on the website for your credit card and just check and make sure that the charges and the transactions that are coming through there are yours, to make sure that nobody's gotten a hold of your credit card information. Be careful with your credit card. You don't ever want to give out your number over the phone or the internet unless you are the one initiating that transaction. And nowadays we all order things on the internet all the time, and we have a lot of instances with websites that will let you store your credit card information in there. Like Amazon is a great example. You can store your credit card information in there. It makes it really easy. You go in, then you want to buy something, and you just click one button, and the transaction is done. Be careful on stuff like that. There's a lot of issues that can arise with that, but two of the biggest ones is, one, the temptation to go spend money is really great when it's so easy to go in there and just click and it's done. And also, when you are storing your credit card information in those companies' websites, just know that there's always going to be a risk that those companies, they can have their databases hacked and your credit card information is out there in the hands of people that you don't want it in. So just be careful on that. Don't give out your credit card number unless you're the one that's initiating that transaction and you know that you're dealing with somebody that's reputable on the other end. And then if you do lose your credit card, or if you have your wallet stolen or something like that, report it immediately so that you can, one, get that card stopped. You can get it canceled. And then two, if you do have any fraudulent charges that have occurred on there, you need to let your credit card company know immediately. Otherwise, you could potentially end up being liable for those charges. Credit cards, things not to do is don't sign up for too many cards. The impulse to spend that money that you do not have is just too strong. It is really, really hard sometimes to have the self-control not to spend that money. If you have got accounts that you don't need, go ahead and close those accounts out. So don't leave those unneeded accounts open. Close it if you do not need it. Some open accounts, if you've got a credit card account that's open and you're not using it, it can open the door for identity theft, particularly if it's a credit card you don't check very often. Some credit cards also charge annual fees. Even if you're not actually using the card for anything, some of them have annual fees tied to them. If you're not using the card, don't pay the annual fee if you don't have to. So if that's not a card that you're needing, go ahead and deactivate the account. Don't just cut up the credit card. Don't just shred it. That does not deactivate the account. You actually have to call the company and tell them you want that account terminated. They will probably harass you a little bit on the other end. You've got to stick to your guns and make sure that you are firm with them and let them know that if you do not want that account, you want it deactivated. So if you do like keeping, say, one extra credit card as an emergency, but you don't use it very often, do make sure you check it on a regular basis. Go in and still make sure, even if you're not putting transactions on there, make sure that nobody else is. And also, if you do have kind of an emergency credit card like that, it's not a bad idea just every once in a while to make some small purchase with it, some small transaction, just to make sure that it's working the way it should and whatnot. And then also, if you do use it for a small transaction, go in and make sure you get that balance paid off so that you don't have any interest generated on it. Also, easier said than done. I've said it over and over, but don't let your spending get out of control. You have to learn to develop some self-control in your spending. It is not easy to do. Sometimes some new, really cool something or another comes out that you just really think you have to have. Stop and ask yourself if you really need that or do you really want it. If it's a want versus a need kind of a thing, determine if you can really afford to buy whatever that is. Also, don't miss payments on your credit card. So most credit cards are going to require some sort of payment, at least on a monthly basis. Don't miss payments. That can absolutely destroy your credit score, and it can take a long time to recover from that. Even if you get back on track and you're making your payments the way you're supposed to, it can absolutely wreak havoc on your credit score, and can be hard to get that repaired in a timely manner. Also, don't just make the minimum payment on your credit card. So if you are carrying a balance on a credit card and you just make the minimum payment, you can end up with some tremendous interest accumulations, absolutely huge, that will take you years and years and years to pay off. I have an example of that right here. So let's say you have a credit card that you carry a balance of $2,500 on, and you have an APR, that's annual percentage rate, of 18%. If you only make the minimum payment each month, and let's say that minimum payment is either the greater of 2% of the balance or just $15 each month. Many credit cards only require like a $10 or a $15 payment each month. If you're just making the minimum, it will take you 29 years to pay off that debt. And when you do pay it off at that 18% interest rate, you will have paid almost $8,400 for that $2,500 balance. Almost $5,900 of that is nothing but interest. That is just money that is gone with the wind that you have had to pay on the $2,500 balance just by virtue of paying only the minimum payment. This is how people get into credit card debt, because that interest is compounding on itself. Your interest is accumulating on the interest, and it can snowball out of control really, really quickly. Continuing with this example, if you instead say pay your minimum monthly payment plus an extra $100 each month, it would only take you about 2 years to pay off that $2,500 balance, and you'll have paid just a shade under $3,000, so about $450 in interest. That's still $450 in interest that you wouldn't have had to pay if you just paid off the full balance, but that's a whole lot better than the nearly $5,600 in interest if you were only paying the minimum monthly payment. So pay a little bit extra if you can, but always, always, always remember, if you will just pay off your credit card balances in full each month, you will never pay interest charges, because the interest is only going to accrue on an outstanding balance. You can save so much money over time. That's money that you could do all sorts of other things with. You could invest that money for your retirement. You could use that money to put towards savings. You could use it toward your interest or your insurance requirements and things like that. So the kind of the moral of the story is try to get your credit card balances paid off each month, and then you will never have to worry about interest charges. All right, so to shift gears just a little bit, we'll talk about some insurance coverage. So very first thing is never, 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 never go without health insurance, because medical bills are one of the major causes for bankruptcy in the US. Things can happen unexpectedly that we're not expecting. People get hurt, people get sick, and you can run up some humongous medical bills if you do not have proper insurance. So one of the very first things to do if you've got excess income is make sure you get health insurance. If you do not have employer provided health insurance, then there are plenty of options out there to get some good private health insurance, and shop around for the best deal. It's kind of like any other purchase you would make. Do your research, do some comparison shopping, find what works for you. Don't pay for more than what you need, but don't ever, ever, ever go without health insurance. And then if you are either renting or owning a home, you need to make sure you have got proper insurance coverage for your dwelling. The idea behind renters and homeowners insurance is that it is protection for unlikely but very unlucky events that could happen, such as fire, burglary, natural disasters, things like that. Usually renters insurance or homeowners insurance is going to offer some liability protection as well, which would be protection from financial loss if someone were to be injured on your property, an accident or something like that. So if you, regardless of whether you rent or you own a home, you need to make sure you've got proper coverage for that. The kinds of events that covers tend to be relatively rare happening, but at the same time, they can be very expensive if they do happen. On life insurance, so one of the questions we received before the webinar actually is related to life insurance, and so I'll get into life insurance in a little bit more detail when I answer that question. But life insurance, the basic premise behind it is that it protects your family in the event of your death. It can do that in several different ways. It can replace lost income that, if in the event of your death, that is income that you would not be earning. It can be used to cover medical expenses or funeral expenses, and can also be used to pay outstanding debt or housing expenses, educational expenses for children, things like that. So life insurance is a very kind of personal thing. Not everybody necessarily needs life insurance. So this is where, before you run out and go buy life insurance, you need to make sure that you are buying the kind of insurance that you need. If you are a relatively young, healthy, single individual, you don't have a family, you don't carry a lot of debt, if you don't own a home, you may not actually need a whole lot of life insurance. But if you are married, you've got several kids, if you've got any kind of potentially serious underlying health conditions, things like that, then life insurance may be something you absolutely need to consider. So you need to make sure that you do your homework on life insurance coverage, make sure that you are getting the adequate insurance that you actually need. Don't just go buy life insurance because somebody told you that you needed to. Make sure you're actually getting what you need for your situation. And then finally, auto insurance. There's actually several different layers to auto insurance. One is what they call Part A. It's liability coverage. This is going to cover damage to other individuals, either bodily damage or property damage if you were in a car accident. The Part B auto insurance is your medical expense coverage, and that's going to cover both you and passengers inside your car if you were to be in an auto accident. Part C is uninsured motorist coverage. That's going to protect you from injury or damage that was caused by drivers who did not have adequate liability insurance. And then Part D is going to cover damage to your automobile. If you were in a collision, then your collision coverage is going to cover damage to your car as a result of that accident. Comprehensive coverage for damage is damage that is due to anything other than a collision. So if we had a big windstorm and a tree falls on your car and it crushes it, comprehensive automobile coverage would cover that. If you're an auto accident, collision would cover that. So there are different layers to auto insurance. There are people out there who have liability coverage and nothing else. That is, that's kind of playing with fire to do that. If you were to have any kind of other issues that arose that were beyond the scope of liability coverage, then you could be on the hook for those expenses. So the general idea behind auto insurance is try to get the best coverage and the most comprehensive coverage that you can to make sure you're covered in all cases. So on home and vehicle purchases, so a lot of people kind of equate buying a home with achieving what they consider financial success, and it's kind of the American dream kind of thing. And home purchasers are usually going to be the single largest investment that most people will ever make in their lifetime. So there needs to be a lot of thought and a lot of planning that go into home purchases. Buying a home needs to be viewed as an investment, and when you buy a home, that provides you with a financial asset that is a potential source of very valuable equity that you could use for other circumstances if you needed to. Vehicle purchases or leases are also major financial decisions. Where vehicles differ from homes is that vehicles aren't generally regarded as an investment because those vehicles, we all know about vehicles and depreciation. Those are assets that just tend to depreciate over time and with use, but they are still expensive and they're major financial decisions. So being that those are very expensive assets, most people are not going to probably financially be able to just make cash purchases for those kinds of things. So you often need to consider financing for homes and vehicles, and you need to make sure that you are educated when it comes to starting to shop around for financing for those types of purchases. If you have done your homework and you can get good interest rates on loans, you can save yourself a lot of money over the long run, especially if you're talking about like a home purchase. If you purchased a home with a 30-year mortgage, you need to make sure that you are absolutely aware of what your interest rate is and how your interest rate is going to work over the life of that loan. In some cases, depending on the way the loans are structured, sometimes people will pay almost double for a house just by virtue of the interest that it accrues over the life of that loan. So you need to do your homework and make sure you understand how this stuff works. So in home and vehicle purchases, I kind of broke it down into 4 main steps. So the very first step is to differentiate between what you want and what you actually need. And this kind of goes for any sort of spending when you really get right down to it, is we all want things that we probably don't necessarily need. So be honest with yourself, be realistic, and decide what do you really, really need and what would be kind of nice to have if you can afford it. And then do your homework. How much can you realistically afford to spend? This is where you go back to your budget. If you've got a well-developed budget, your budget is going to tell you how much home or how much car you can actually afford to buy. Do not blow your budget on a home or a car just because you want it when you really don't need it. Do your research. Do research on the quality of whatever the asset is, whether it's a home or a car, the features, the prices. Spend a lot of time doing your research. You will be glad you did. When you actually get ready to make the purchase, just know it's probably going to involve some negotiation, particularly on cars and houses. There is a lot of negotiation that usually goes back and forth. Shop around on your financing options. Shop around for the best interest rates. It's just like any other purchase you would make that would be a fairly large investment of money. Different places are going to give you different interest rates. So if you're buying a car, for example, don't just think that you're stuck with going with the dealer financing. You may be able to get a lot better interest rate if you go to your bank or vice versa. So shop around. Same thing on a house. Whenever you're getting ready to buy a house, keep in mind that most mortgages are either 15 or 30-year mortgages, and you are going to be looking at paying whatever that interest rate is for a very long time. So make sure you get an interest rate that is something that works for you. There is nothing wrong with doing a lot of shopping around for interest rates, and if you get quoted one interest rate from one lender, there is nothing wrong with taking that and using that to your bargaining advantage with another lender. You can kind of negotiate on those things. And then when you actually decide what you want and you made your purchase, then you want to maintain it. Regular maintenance is going to extend the life of that asset. So whenever you get your home or your car or whatever it is, then make sure you take care of it. The better that you maintain it, the better you're going to retain value in it, particularly in homes, and make repairs on a regular basis as you need to, things like that. On your car, the better maintenance you give it over the life of that car, the longer it's gonna work for you. So on these types of purchases, because these are large purchases, you need to consider various expenses that are related to it. And there's usually going to be multiple types of expenses. So you may have initial or one-time costs. So for example, a down payment. So if you're buying a house or a car, you may need to make a down payment on it. So if you can save up a large down payment, you can end up saving a lot of money over time. The larger the down payment you make on whatever it is, whether it's a house or a car or whatever, the larger that down payment, the less financing you are going to need. The less you finance, the less interest you pay. It's as simple as that. The less interest you pay, the more money that stays in your pocket. So take the time and try to save up as large a down payment as you possibly can on these large purchases. Then take into consideration recurring costs. So these are going to be, if you're financing more than often, these are your loan payments. So make sure that you have looked at your budget, going back to your budget again, to determine how much can you comfortably pay on those loan payments. And most of the time those loans, car loans and home loans both, are going to be monthly payments. So make sure that you have got adequate cash flow year-round to comfortably manage those loan payments. And then you need to also consider your maintenance and operating costs. Cars have a tendency to have things that go wrong and they need to be repaired. Same thing with houses. When you least expect it, your plumbing goes out or something like that. So you need to factor in your maintenance and your operating costs. So again, going back to your budget, figure out how much can you comfortably pay for repairs as they come up, renovations if you want to make renovations to a home, upgrades if you need to upgrade something. You can budget for all of that stuff and make sure that you're budgeting what you can actually comfortably pay for, not what you think might come up, but actually sit down and crunch the numbers on it and make sure that you're not getting yourself into a hole that if something really major came up expense-wise, that you wouldn't be able to cover it. Okay, shifting gears over here to retirement planning. So the best advice for retirement planning is start early. You probably can't start planning for retirement early enough. People tend not to plan early for retirement because they think that's a long way off. Well, it's not going to be as long as you think. Also, don't plan to rely on Social Security. So you need to be able to develop a retirement plan that's going to enable you to have enough income in retirement to live comfortably. That's up to you to determine what do you consider comfortable, because everybody's idea of comfortably is a little bit different, but you want to make sure you can do that without having to rely on Social Security. There's a strong possibility by the time a lot of y'all get ready to actually retire, Social Security may not even be around at that point. So we need to make sure that you have got a plan to retire comfortably without having to rely on that. So a lot of folks may have an employer-provided retirement plan. That is always a good idea to make sure that you are paying into that retirement plan. In some cases, some employers don't even give you an option. It is a requirement that you have to pay into that employer-provided retirement plan. If you don't have an employer-provided plan, or if you're self-employed, there are still some really good options out there for setting up a retirement plan. And that might be where you would want to talk with a professional financial advisor to determine what your best options on that might be. If you have an employer-provided plan, then you might want to determine, do you want to make additional investment? If you do want to make additional investment, there are a lot of vehicles out there to allow you to do that, but you need to do your research and find out what would be the best option for you and how much would you want to put into something like that. So when it comes to retirement planning, you have to start with what are your goals. So determine what your lifestyle in retirement is going to be. For some people, that may be more elaborate than the way they live as they're going through their working years. For some people, it may be simplifying that. Some people may want to have a second retirement vacation home, which would be kind of expanding on their lifestyle. Some people may want to simplify, sell, downsize, get a smaller house. That would be kind of contracting on their retirement lifestyle. And then also taking into consideration, if you think you may need to have money available for medical conditions, a lot of times people know that they've got a genetic history or a family history of some sort of medical conditions that they may need some sort of long-term care for. If you think you might need to be prepared for that in the future, then make sure that is part of your retirement plan, is that you're going to have money available to treat those conditions should they arise. Determine if you're going to have either relocation or travel expenses. For a lot of folks, when they retire, that's what they want to do. They want to go travel, or they may want to relocate to a different area of the country, or they may want to relocate internationally or something like that. You need to determine what your goals are and then plan adequately for that. And then finally, determine your time frame for your retirement goals. Some people may want to retire early. Other folks, they want to keep working into their retirement years, at least part-time, and that's going to change the dynamics of how much you need to have in your retirement plan substantially, depending on what your goals are for that. So here's a really simple retirement planning example that I put in here. So let's say we've got a 22-year-old who wants to retire at age 67, kind of standard retirement age, and they want to retire with $1 million. And $1 million sounds like a lot of money, but keep in mind, if you're retiring at age 67, that $1 million, you're going to have to live on that for the rest of your life. So you need to make sure that the kind of retirement goal you have is going to support those plans that you have in retirement. So let's assume that this person can earn an average annual rate of return of 10%. So this is actually 10%, 10 to 11% is the approximate long-run average return of investment in common stocks. So when we're looking at a long time horizon, in this case it would be a 45-year time horizon, if we were able to invest in common stocks and earn that average long-run rate of return of about 10%, that person would actually only need to invest about $95 a month over the course of their working career. So it sounds like a big goal, say, oh, I want to have $1 million when I retire. But if you start planning early and you plan adequately, $95 a month is not that much. That's pretty easy to set that aside if you will just plan for it. So it can be easier than you might think to be able to build up a good retirement plan. The one thing to keep in mind with retirement planning is don't forget about taxes. There are a lot of vehicles out there for retirement planning that can help kind of mitigate the effect of taxes. This is, again, where working with a financial advisor can be really, really useful to help to have somebody to kind of help walk you through the different options for your tax management. But if you plan carefully, you can significantly reduce your income tax burden during retirement, which is always a good thing. So kind of to wrap things up here, just sort of to touch base on everything I've talked about here. First off is develop a realistic monthly budget based on your expense tracking and stick to it. That's the hard part, is sticking to it. But if you'll stick to it, it is very eye-opening what you can learn about yourself. Aim to build up your savings. 2 to 6 months is kind of considered your kind of baseline for an emergency fund. Be careful with your credit cards. It's really easy to let your credit cards get out of control. If you use them wisely, though, they can help you a lot. They can help you build up your credit score if you are paying them off every month and not letting your spending get out of control. Make sure you have proper insurance coverage. Make sure you have health insurance. If you rent or own a home, you need homeowners insurance. Determine whether or not you need life insurance, and then make sure you have adequate auto insurance. And then on home and vehicle purchases, do your homework and only buy what you realistically can afford. That's going to go back to your budget. Your budget is going to tell you what is realistic for you to be able to manage on those things. Don't go buy more home or more car than you can afford. It will only cause problems. And then on your retirement planning, start thinking about that early. You don't have to invest a whole lot, but the key is consistency. So try to keep some consistent investments going as far as putting money aside into saving for retirement. And you might be surprised that, like the example I just showed you, you might be surprised how easy it can be to save up for retirement if you start early. The earlier you start, the less you actually have to set aside on a periodic basis to be able to reach your goal for your retirement planning. So with that, I think that's all of my slides. Okay. All right, so we received a question ahead of time that was, the question was actually asking about cash value life insurance and what might be the best circumstances for using cash value life insurance. So there's a lot of ground to cover on that question. That's a great question. So to really give you a full answer on that, I'm actually going to talk a little bit about the difference between term versus cash value life insurance. So term life insurance, there are several categories of term life insurance, but there's not too many of them, and they're fairly easy to follow. But the way term life insurance works is that when you buy that insurance, it's going to pay your beneficiary a specific amount of money if you die while you are covered under that insurance plan. It's as simple as that. You buy the policy, and if you die while that policy is in effect, your beneficiary receives the payout on it. The premium that you pay for term insurance is going to be based on the actuarial probability that you will die during the term coverage. So without getting too much into the details on it, there are actuarial tables that you can look up, and the probability that a person will die is based more or less on their age. So it makes sense that, like, the older somebody gets, the more likely you are probably to die. So when you purchase term life insurance, it's going to be for a set number of years, and if you were to die within that time period while you are under that policy coverage, then your beneficiary gets the payout on it. That's the basics of how term life insurance works. If you have paid into that policy and you don't die within the term of the policy, which hopefully you don't, then nobody receives any benefit from that. So it's kind of taking a gamble that if you die while you're covered, then the payout comes through. Otherwise, there is not going to be a payout on it. There is no cash value with term life insurance. The sole purpose of term life insurance is to provide a death benefit to the insured person's beneficiary. The reason why term life insurance is really popular is it is very affordable. You can get some really good term life policies for relatively inexpensive payments. The disadvantage to term life insurance is that the cost is going to increase each time you renew the policy. And the reason why the cost is going to go up is because you've gotten older since the last time you bought the policy. And so actuarially, it would be more likely that you would die under the coverage. Now, the opposite of, or not opposite really, but the alternative to term life insurance is cash value life insurance. So cash value life insurance is, there are a ton of different varieties of cash value insurance out there. There are almost an infinite number, actually, of cash value variations. With cash value insurance, there is a life insurance component and a savings plan component. Some of the premiums that you pay on the insurance policy are going to go toward the life insurance component. Some are going to go toward the savings component. When the insured person dies, the beneficiary is going to be paid the savings as a part of the death benefit. So cash value life insurance provides a death benefit and an opportunity to accumulate a cash value. It is permanent. So where term life insurance is only for the specific term you bought it for, cash value life insurance is permanent. So it is going to eventually result in a payoff. Okay, so if you continue to pay your premiums on a cash value life insurance policy, eventually your beneficiary is going to get paid. There are three basic types of cash value life insurance, and like I said, there's almost an infinite number of variations within here, within those varieties. But the three basic types are whole life, universal life, and variable life. So I'm going to just kind of give you a real quick overview of each one of those in order. So whole life insurance is where you receive the death benefit when the insured person dies, turns 100, or reaches the maximum stated age on the policy. The cash value with that policy is going to be the savings component of the policy. Whole life insurance does not provide the level of insurance coverage that term life insurance does. And the yield on your savings proportion is often not going to be competitive with other types of investments. So when it comes to looking at whole life insurance, you're paying a pretty high premium for relatively less coverage as compared to term. And the savings portion of it, yes, it does earn a rate of interest and a return to it, but you would actually be better off probably putting that savings into some other sort of investment that could pay you a little bit higher yielding return on it. Where whole life insurance might be useful is if you have a child or spouse that you know is never going to be financially independent. You might want to consider whole life insurance because there is a guaranteed payout that comes with it. But in general, what you kind of get in return for what you're paying for whole life insurance, your return it's hard to justify the expense of it sometimes. With universal life insurance, so this is another cash value variation. It combines your term insurance with a tax-deferred savings. You have flexible premiums and flexible benefits. So people say, oh, well, premiums associated with it are flexible. That's great. Well, the problem is if you have a relatively consistent income, those variable payments that you would make as paying for your policy may not be of a whole lot of use to you. Now, if you have a pretty uneven fluctuating income, then universal life might be something to consider because you can adjust your premiums as needed. But the money that you put into a universal life insurance policy can be broken down into three parts. You've got your mortality insurance, so that's your basic term life insurance. You have the cash value or savings component, and then here's where they get you on universal life insurance: administrative expenses, and they can be very, very high. So that premium you're paying, a lot of that money may be going directly to your administrative expenses, not so much to your insurance and not so much to the savings component. The returns on universal life insurance can vary dramatically because of your flexible premiums, and the insurance company may charge really high interest expenses that do not vary when your premiums are varying. So what that results in is you may not end up with as much savings in that policy as you thought you might have. you need to be careful with universal life insurance. There's not really a whole lot of situations where that's the best option for people. The third major category of cash value life insurance is variable life insurance. It works really similarly to universal life insurance. The difference on this one is that the investment portion is now falling on the responsibility of the policyholder, not the insurance company. So what that basically means is that you as the policyholder, yes, you're putting this money into a savings component of it, but you are responsible for managing the investment of that. So you, the policyholder, are subject to all of the risk of the variability and returns with that. So you have to be really, really cautious. Variable life is a situation where if you're a little bit of a gambler and you've got some money that you can put into that policy, you might play with it and you might be able to do pretty well with it. But there's not a lot of cases that for people who are relatively risk averse that's probably a very good situation to get into. So be very, very, very careful with variable life insurance. So for most people, this is kind of my takeaway on the life insurance thing. For most people, term life insurance is really probably the better bet for most folks. It is relatively inexpensive. You can get a lot of coverage for a pretty low premium. The cash value option on life insurance sounds really great. It sounds like a great deal, but what you actually end up finding is that the savings component that you get is you could actually do better if you just invested in some other financial asset. You get better return in a lot of cases, and a lot of times you don't end up with the same level of insurance coverage as if you had gone with a similar equivalent term life insurance policy. So really, whenever you get into cash value insurance, there are really no advantages of cash value insurance over term life insurance. The only advantage might be when it comes to taxation, because the growth of cash value insurance is tax deferred. So you're not paying tax on your savings accumulations while it's accumulating. And then life insurance is not considered to be a part of your estate. So if your estate was large enough to be subjected to estate tax, a cash value life insurance policy wouldn't be covered in, it wouldn't fall into that, so you wouldn't have to pay estate tax on that. But beyond that, beyond a couple of tax advantages, there is really, in most cases, not a whole lot of advantage of cash value over term life insurance. So sorry, I know that was a long answer to that question, but the key with life insurance is kind of, as I mentioned in the presentation, is do your homework and make sure you're getting what you really, really need on that. If you're looking for investment options, there are probably some better options out there than cash value life insurance.